Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information here today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today during our question and answer period as appropriate. If you ask a question in the chat box and we don't have time to get to it, go ahead and leave your phone number as well. If we can't get to your question, we will make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's moderator. Christopher Sukup has been educating clients for 13 years by helping them protect and grow their assets through investment management and financial planning. He is a wealth manager with Lighthouse Financial Services. He has previously worked for several large financial institutions, both in a managerial and financial advisor capacity, and is committed to a fee-only advice model. Christopher received his bachelor's degree from California Polytechnic State University, San Luis Obispo in business administration, and his Master of Business Administration degree from Western Governors University. Christopher has 3 primary business beliefs: continuing improving the client relationship experience, always adding value to a conversation, and providing candor and transparency. Chris, why don't you go ahead and come off mute and say hello?
Hi, everyone, and thanks, Marche, for putting this together today. As I mentioned, or actually, if Marche has mentioned, I'm Chris Sukup, a wealth manager and financial planner at Lighthouse Financial, and also today's moderator for the webinar on understanding annuities. The main purpose, as she had mentioned, is really to provide education, around the advantages and disadvantages of annuities, which will ultimately empower you to make better informed decisions. I'll also be monitoring the chat box where you'll be able to type in questions, and we'll be addressing them at the end of the webinar here. Thank you.
Thank you very much. And we did have a question in the chat. What number should we use for further questions? Just go ahead and leave your number if we don't get a chance to answer your question during the webinar, and we will reach out to you directly. But go ahead and use the chat box to put your questions in during this presentation, and we will try to answer those during the time we have today. So thank you so much for your question. And I am pleased to present JC Lowe, who will be our speaker today. As a wealth manager for Lighthouse, JC works closely with clients to turn their financial goals into customized strategies. He brings over 7 years of experience in financial planning and client service. Prior to joining Lighthouse Financial, JC served as a financial advisor for Next Financial Group, LLC, a Texas-based broker-dealer and advisory firm specializing in providing investment and financial planning solutions for individual investors. He has also served as a financial advisor and a trading manager at Lowell Wealth Management, a broker-dealer and a registered investment advisor in Texas that served high net worth clients with financial planning solutions, investment management, and alternative investments. JC holds a bachelor's degree in personal financial planning from Texas Tech University. And JC, I'm going to go ahead and stop my share here and turn the time over to you.
All right. Good morning. Good afternoon, everyone. Thank you for joining today. This is going to be a fun education event that we're going to do. I really enjoy doing this topic because not a whole lot of individuals and families know a lot about annuities. So, let's just kind of dive into it. Just let's kind of dive into this. So understanding the basics of these annuities. We're going to review what types of annuities are out there, the purpose of the annuities, 10-year evolution. I like looking into that because it shows you the background. We're going to walk through how annuities are built, volatility that you experience in the market, and the reason for why people buy annuities, service that you receive from your sales rep. I'm going to go through a variable annuity. When it says VA, it means variable annuity explanation. So that's going to go through how they're built, how they function, how they serve you. And then I've added in here, understanding your statements. This is really key for a lot of clients, is whenever you get that first statement, it's kind of like trying to understand, any kind of foreign language, especially if you don't speak it. It's not going to make a whole lot of sense. But in totality of this entire presentation, I want to empower everyone listening in and watching to be able to make an informed decision on what to do for your future, or what if you're going to have an annuity in the future of what that is. So, all right. So the fixed annuity. So whenever you hear fixed annuity, these can be sold at insurance companies, banks. If you have a AAA branch, you'll see kind of their rates on the outside of the building, or any other financial institution. So fixed annuities are very simple. It's similar to a CD. You get a fixed rate and you can do it for 6 months. You can do a year, 5, 10, however many years that you choose to do it. The higher in the maturity, the higher in the years, the higher the interest rate is. Of course, right now, with interest rates being pretty low, fixed annuities don't really present that much of an investment opportunity. And it's very simple to understand. If you invest $100,000 in one of these fixed annuities and you're generating a 1% fee, you get that for 1 year, and at maturity, you get $101,000. So very easy to understand in situations like that. So now fixed indexed annuity. So this is a step up from a fixed annuity. So fixed indexed annuities, you'll see these at financial insurance institutions. This is for anyone that has a mutual fund or a Series 6 license coupled with a insurance license. So this has an investment component. So it's typically going to be tied to an index, and that is completely on the investor's side. So whatever they want to do. So some of these are typically difficult to understand, and with my extended experience in the industry, it took me a while to understand how they function, how they're broken down, and how they serve the client. So basically, the easiest way to understand this is you sign up inside of a fixed indexed annuity, and you choose an index that you want to choose. So it can be the S&P 500, it can be a bond index, it can be anything else that they might have on their platform. So let's just say you choose the S&P 500. So the first thing to understand is that fixed indexed annuities, they have a ceiling of how high that you will be credited, and they also have a floor. So the floor is going to be basically zero. So if the market goes negative, you get no participation in that negative market. But if the market does really well and you have the S&P 500, and let's say it does 15%, you'll be capped, and you'll be capped at, for example, 5%. So you can't go higher than 5%. So that will be credited to your account. And in some terms, the crediting of the account can be on an anniversary date. It's typically going to be whenever you sign up. And some of those are kind of the catch-22s. I've worked with clients in the past where they thought that they were going to be credited at a certain amount because the market did so well in 1 year. And then, come to find out, we dig into it and they say, well, no, it's credited to the anniversary date. So it wasn't, to that amount that they thought it would have been. So crediting to an anniversary date. It's not going to be on a point-to-point the beginning of the year to the end of the year. So that's kind of one thing to understand with fixed index annuities, is they can have catches inside of it. You have to understand exactly what's being presented to you on that side so that you get credited. Another thing that I've noticed with fixed index annuities, they have long surrender periods. I've seen some with 10 years or more. And that's not an issue if you get inside of an annuity, if you want income protection, if you want the protection of the market going down, that's not a big deal. But it's just good to know that these things have long surrender periods. All right, so now the variable annuity, the VA. So this is probably what everyone is very familiar with. Everyone has been offered a variable annuity probably at some point in their financial future. If not now, you will be. If you speak to multiple financial advisors, you'll be offered and sold one of these. So you'll see this at any financial advisor that has a broker's license. Even variable annuities now are fee only, so they're actually offered on our side. So a fee only financial advisor can sell annuities, and they're sold differently. The advisor's compensated on the fee method, so it's not driven on commissions. So in this investment vehicle, this variable annuity, it allows you to choose investments, and these investments are going to be in what's called sub-accounts. So they're going to be mutual funds. So you can think of any popular mutual fund that you can get invested in, and these will do exactly what the market's doing. So inside of the variable annuity, you're going to have two different buckets. You're going to be able to generate, on the cash side, you're going to have your mutual funds that's going to be growing. And then you're going to have your guaranteed side that has your riders, that has everything built up inside of it that's growing guaranteed on an annual basis. So variable annuities, there's a higher investment risk, especially with your cash side. And I'll present that here in a few slides because we'll go over guaranteed side, cash side, and it'll make a little bit more sense. But you have investment risk. Fees can be high. They can drive down performance. It's going to be locked away for 6 or more years. If you decide to get out of it before the 6 years, you're going to pay a surrender fee. So you kind of want to be cognizant of that. You want to understand exactly what you're getting yourself into, because annuities and variable annuities, they're good for some, but they're not meant for everyone. So yeah. All right, thank you, Marche. So the purpose of an annuity. So the purpose of an annuity is what I've told a lot of my clients and everyone that I work with. It's meant for individuals where they have a strict income need. And income is key, and that's why I have it in all caps and everything else. Is annuities are meant for people and clients and everyone else that need income, and they want protection from an insurance product. And you're going to pay for it. They can be expensive, but you're paying for that protection. It's going to be for someone that wants something more, that's going to earn something more than a CD and everything else on that side. So the purposes of it: income, protection, and something more that's going to pay you than a CD. So one thing that I do mention is, in the insurance world, we call it the G word because we can't say it to clients whenever we're offering investments. And since we are talking about insurance, it's called guarantees. So guarantees, you will see it all over annuity products. You'll see it all over insurance products. The way that annuities are sold, and I kind of want to tell everybody right now, I'm not bashing annuities. I'm not bashing annuity salesmen. There's some great people out there that offer these products that do a fantastic job. So I'm not bashing it at all. We just want to disclose this and tell, everyone, annuities and how they're sold. They're going to be sold to a lot of people like they're short-term insurance policies on their investments. So why wouldn't you buy something if it's going to provide insurance? But they're not, and we'll go through that here in a minute, because they can be very, very expensive. So people that are selling those annuities, they're going to guarantee that it's going to pay your income. It's never going to run out of money. In all honesty, what it is you have to keep that company operating. You have to sell annuities and everything else to keep everything running. which if they're sold in the right light, that's fantastic. But at the end of the day, you are pinning your future on the financial strength of that annuity provider. There's no guarantees. The reason why I say that is in the past, I've worked with multiple people where they've had investments that were sold 7 or more years ago. And the annuity company comes back to them and they say, hey, this product that you had was 7% guaranteed per year. We're going to give you an option. We're going to give you cash to go away and do something else with this money, or we're honestly going to drop you down into something else. And it's going to be a lower interest rate. And it's going to be anything else on that side. So at the end of the day, you are pinning your future to the financial strength of that annuity provider. Most insurance products are guaranteed by the state, but at the end of that time, if you're drawing income, if you're doing everything else, you don't want to be waiting for your money. So everything has a risk, in my opinion. Everything has a risk. You're willing to take that risk of it being provided and guaranteed inside of an annuity. Nothing is guaranteed forever. All right, so the reason why I go over this slide is annuities in the last 10 years and even further is I've noticed through all of the volatility times of the market, annuity sales are incredibly high. The reason why they're incredibly high is people feel pain in the market. You're going to feel that the market's going down. You're watching your investments just dip, and annuities jump in because they know that that's a great time to sell. And it could be that someone gets to that point in their life and they need income or they need guarantees, they need some sort of product in that side. But the reason why I bring this up is look at the amount of billions of dollars sold, and this isn't each market cycle or market time when the market wasn't playing nice. So a lot of clients that I've talked to in the past, they've thought that a regular or an annuity is like a regular brokerage account. It's not. There's rules inside of it. They think it's like that with a guarantee on their market value. They're not. So yeah, that's the rise of it in 10 years. So here's another graph that I like to bring up, and this just kind of proves a point that the long-term investment, and this is for people that may not fully need the income, that may not understand that the market is volatile and it goes up and it goes down. But the reason why I bring this up is for clients to understand that you're going to be sold on volatility, that the market's going down. In the last 20 years, we've had 4 negative markets, and that's generating by the S&P. So whenever you think of that, you think of the last 20 years, you look at the overall turnover of that market. So in the last 20 years, you could have averaged a 7.6% return if you were willing to hold steady in the market. And I mean, that's fine. You can hold steady in the market. You can be in an annuity. But what you don't want to understand is kind of be a cynic of the market, because the market's going to go down. It's going to go up. If you're being sold on an annuity, obviously you want to do it for income purposes only. But the volatility in the market, you're going to be sold more in times when volatility drives the market down. You just want to kind of understand that it's always going to be in that upward cycle, that upward right quadrant, as long as you're willing to hold on for the long term.
And I'll just put in here that that's historically what has happened, but we can't make a guarantee about what the market will do in the future.
Exactly.
And that's just that's just a qualification we have to make.
Yeah, that's disclosing, and we don't guarantee anything, not even looking at the market, because we don't know what it's going to do tomorrow. So service that you receive from your annuity reps. The reason why I bring this up is because of the historical trends that I've seen with clients that I've worked with. They've had a friend that sold them an annuity. They had an advisor, a fellow advisor, someone that they can't reach out to anymore. Maybe they left the business, anything else. The service from your annuity rep is going to be a key proponent of how you feel about that annuity. If you're just receiving statements, nobody's talking to you, you're not having conversations, your service with that product is probably going to be really low, and you're not going to have a great experience with it. So the reason why I say this is, do you understand your statements? The statements are going to have multiple graphs and multiple lines on it. It's very confusing to understand what your statement's trying to say. And then if you have questions with that annuity, you might call the annuity company and then, are you asking the right questions? And do you understand the jargon that the representative on the other line is saying? So I always put this out there for everyone to understand is service with your financials should be the main feature that's sold to you, because I've seen products change. Chris has seen products change in all of our lives of being advisors, and products get old, they get outdated. Can that advisor that sold it to you, or can that person that offered it to you, can they assist and provide you the proper service for that situation? And that's the main thing that you want to understand is your product, you might have bought it 10 years ago, but it's kind of old and outdated. And if you probably noticed, they don't sell it anymore. So the annuity companies understand that at a certain point, the products get old and outdated, and they expect people to go through and start drawing off income on it. So this is what I was explaining a second ago. I was talking about the variable annuity explanation. So on the left over here, we have a safe, and you can't touch it. You don't even know the combination. And then we've got this bucket over here on the right. It's an open bucket. It's like a rainwater bucket. So it can fill up, it can go down, it can do everything else. So in a situation, let's say you have $100,000 to invest. Well, you write that check or you transfer assets into an annuity. They're basically going to take $100,000 and they're going to place them into both of those buckets. Now, that doesn't mean that you have $200,000 now, but this is how they separate them, and this is how it's going to look on an annuity statement. Is the guaranteed side, you're going to have, with whatever riders that you decide to get into. So living benefit. Living benefit basically means that your income all the times before you annuitize is going to grow at 4% a year, and you get that living benefit every year. And that's, as long as, if the surrender is 7 years, or if you don't annuitize until 10 or 15 years, you can basically grow that account by 4% a year. So you're going to have that inside of it. And then what you're also going to have is you're going to have the guaranteed minimum death benefit. And you can put that at the same amount as what the guaranteed income benefit is growing at, but you can also have it lower. So the guaranteed side is reserved for if you pass away, this is what your beneficiaries get. It's also reserved for if you annuitize. So you will never be able to unlock this side and say, I want $50,000 from this side. Can't happen. Annuities and insurance companies won't let it happen. Where it's going to pull from is from the right side. So this is typically going to be the cash, the market, and the surrender value. So your money goes in it. If market volatility, if we have a bad part of the market that goes inside of it, you're going to have market volatility that can disrupt this side. You're going to have fund expenses. You're going to have fees of the annuity company that are pulled in on this side. And everything else on that. And then the cash distributions. If you decide to take out money, and, because you can do 10% a year with most annuities where it's penalty free, you can pull it out of this side. So all of your expenses, everything else is being pulled in and pulled out of the cash market surrender value. All right, so let's look at this variable annuity statement. So this is an example, and let's talk about the open bucket and then the safe. So the open bucket is going to be on the account activity summary. So you think of the open bucket as right here. So you have your fees, market performance, distributions if you pull out any money inside of this. So this is going to kind of be an example. If you invested $75,000 in 2007, the since purchase date, it's over there on the far right there, Marche. Yeah. This is how difficult they can be with statements whenever you're looking at them. They're hard to find information. So say if you put in that amount of money, you put it back in 2007, and then you're going to have, think of 2007. What happened? We had 2008. So you think of all the information that I just kind of disclosed to you about fund expenses and everything else. And you're going to see all that stuff getting yanked out of that portfolio. So since that purchase, if we go down into that other portion where it says the current total account value, well, that's going to be right now as of date. So if you put that much money in and then you saw what the contributions and no distributions and market performance, that's what it's going to give you is the 74,000. So open bucket, that's what the annuity company can pull from. Now down a little bit lower when it says your optional benefits and values, that's where you're going to get the living benefit right there. And then down below that a little bit further, it says death benefit. So these two are going to be the exact same. So this is where your riders are built into that policy. So you're going to have 4%, 4%, or whatever you select. So most of these are going to be built in there. In this account, you cannot pull from it. You can't pull money out of the safe account. This is the annuity company basically locking up this money and saying you can't touch it. So I mean, it's fine if you're going to take this account, annuitize it, or if you pass away and it rolls over to a beneficiary. It's wonderful. But if you kind of see that I did the work on seeing how much was pulled out, and if you were invested in that in 2007, you put 75,000, the annuity company basically charged you 5%. And it's fine if you're going to leave it in there, but if you're going to leave it like like an investment, it's not going to do what you want it to do. All right, and then now this is just a little bit further on the statement continued. So this is an example. If you go in and you basically have your investments inside of an annuity company, you think of fund expenses and you think of all these other things. So if you were even invested in 80-20 mix, now 80-20 is, and that's our industry jargon, 80% equity, 20% bonds. So it's not going to be completely tied to the market. It's going to have a little bit of risk mitigation. You're going to have some situations there where it controls risk a little bit. But then you look at it and you go, okay, well, if I was invested in that throughout this whole time, the S&P did 10.8, which 10.8 a year since 2008. So you think of 80% and 80-20. Well, it didn't do, much different than 10.8. It probably did about 8% per year. So once you look at it and you go, well, why was this performance so bad? The reason why it was so bad is in each one of these funds that you see that you were invested in, hypothetical, you were invested in this, you basically seeing every fund company, every one of those is an expense. So you see right here, you got fund numbers, you've got the international, you got large cap, equity managed. You can be completely diversified in this portfolio and it's great. But you want to think of the fund expenses. It can be all the way up to 1.5% per fund, and it can be, maybe 0.25%, whatever the case is. But all these are expenses. All these are fund expenses. They're going to be pulled out of that open bucket. So that green bucket, that's what the annuity company is going to yank it out of. So again, this is not going to benefit, an annuity is not going to benefit somebody that wants to have an investment skew inside of the portfolio. It's going to benefit someone who locks it up for income. So, all right. And then this is just the last one. This is an illustration. The reason why I bring this up is I put everything into one Excel spreadsheet. So over here on the far left, you've got the growth of what the account could have grown to, and this is guaranteed. So again, safe. So this is the safe with the combination that you don't know, that you can't access. So it's locked up. It's growing whatever percent per year. So, and I guess one thing I want to point out too is whenever you look at 2008 and you look at account balance compared to over here on the right where it says account balance in the 80-20 mix, that's the difference. That's why that's why investors go into an annuity is you look at that protection and it's great. You can't access it, but if you're in it for income, you don't care. But then on a lot of this on the right, I'll kind of disclose to you, you've got the market performance, and this is historical. This isn't anything that we're trying to make up. This was pulled off of everything on the internet for an 80-20 mix. So you got market performance, you have the fees inside of that account. So you really see the market performance minus the fees and you get the net performance. And that's where you get the account balance. A little further over to the right, you've got the surrender fee. That's going to be every year. So that's that account. That's that amount that you're basically charged every year if you pull out of that annuity before your surrender period is up. So you just see everything inside of that. If the client would have held it for, since up until 2020, you could have walked away with $94,000, but that's a lot of time to be invested in something that it's not generating that much. So, also, if you would have kept it in there, annuity companies can be sneaky about what they're going to charge you if you decide to pull your money out, and they can charge you a certain fee if they want to, and that's what they can do. And you kind of see that, that annuity can take $979 bucks out of your cash account. So again, it's pouring salt on the wound if that's what you kind of want to get yourself into. But it's annuity. It's for income. It's not for investment purposes. And this is a prime example of why. All right, so annuitize. So most of you have probably been going, what does that mean? Annuitize, I don't even understand what that word is. So annuitize is basically, you're telling the annuity company, okay, I'm ready. I want my income. Let's figure out what we need to do with this money. So annuitize is you place that money into the annuity's hands. You take it out of your investments. So it could be, in the S&P index, or it could be in some sort of growth mutual fund. And what the annuity company is going to do is they're going to take that investment, they're going to take the guaranteed value, and they're going to go over and they're going to more than likely put it into a bond portfolio. So what they're wanting to do is they're wanting to draw this income out, and they're going to guarantee it for your lifetime. So what they're basically going to do is they're going to get together with their insurance actuaries, and they're going to make you fill out a new form that basically says, I'm this old, this is, I've been in this investment for this long. So the actuaries are going to start crunching numbers, and they're going to say, okay, a person that's going to live up until age 90, and I leave the example in there, age 90, you're going to get about 74.42.16 a year. So that's about 620 bucks a month. So you can be issued this check on a monthly, quarterly, annually basis until the principal is depleted, or you basically pass away. So there are some annuity companies that say it doesn't matter if you have $1 in the account, we will pay you out. And some of those are really good. And I've looked into them, and it's honest, it's truthful. They will pay you out. Even if you only have $1 left in your account, they will pay you. They'll continue to pay you as long as you have money in there. But one of the big risks with this is, let's say you go into and you annuitize. What if the bond market underperforms? What if we have a horrible situation like 2008, but it's multiplied multiple years after that, and you have all of these municipal bonds that are starting to, completely get thrown, upside down. You're stuck in annuitization. You can't go back to the annuity company and say, I want all my money. Give me all my money. They're going to say, I'm sorry, you signed an insurance contract. You signed this. You have to abide by what you signed to. So you're stuck. And the only way that you could probably get your money from something like this is to have a huge lawsuit with a company and have multiple people involved, multiple investors like yourself. But really, your money's going to last as long as all of these investments last. So that's something, the guaranteed word is great. It makes everybody feel great inside. But at the end of the day, it depends on what's going to happen in the investments. And if we go through a really hard market, that's going to be difficult for it to last a lot longer than that. So, okay, Marcia. All right. So what to do? So you might have an annuity and you have options, because you do. The only option that you don't have is if you annuitize. You're kind of stuck in that one. So if you are pulling cash from it right now, there's really nothing you can do. So you have to continue to take your cash and just continue to take it for your lifetime. But you can surrender. If you do have an account that's not annuitized, you can take that cash. So you can surrender the cash. And just one tax notice is you will be taxed as income on earnings higher than your original investment. So this is if you have it in an individual joint or something like that. So if you pull it out of the annuity and you take it and put it in your checking account, you're going to be taxed on income that's more than what you put in it. So that's one of the differences. I've had people in the past that couldn't get life insurance. They just couldn't, the actuaries wouldn't write a policy and said they were uninsurable. They've gone into annuities. So they went into the annuity for the death benefit. Now, the bad thing is when you pass away, it goes to your beneficiaries. Well, they're taxed. And that's not unlike, it's very unlike a normal insurance policy that's tax-free. An annuity is taxed completely different. It's completely different investment vehicle. So let's say that you do want to transfer. You don't like the annuity company. You can take some of this money out. Well, you can move it in multiple different ways. So if it's going from an IRA annuity to an IRA brokerage account, you're switching from an IRA vehicle, but you're staying in an IRA vehicle. It's okay. It's no tax. You can move it over. There's no consideration with that. If you go from one IRA annuity to another IRA annuity, no tax. It's kind of obvious. If you go from individual joint annuity and you go to another company that's an individual or joint annuity, it's called a 1035 exchange. That's okay. It's no tax. You just lose your guaranteed value. You kind of lose your guaranteed value on all of these transfers, but you don't have to pay the taxes. Now, where you're going to have that taxable consideration is if you move from an individual joint annuity to an individual joint brokerage account, or if you move it and you take it into your bank account and you move it outside of that annuity or outside the IRA, that's where the income is going to be taxed. And you're going to be taxed on earnings above your original investment. So if your money doesn't grow, then you just basically get all your premium back. But if it grows, anything in excess, you're going to be taxed at your income rate. So that is kind of one misnomer out there you want everybody to understand. Okay, Marcia. So financial planning. Annuities do fit in. They really do. They can be a great financial planning tool. Now, I didn't want this whole explanation to ever have everyone just doubt annuities and think they don't fit in. I'm kind of the type of advisor that if everything's going right, well, I'm going to look at something and go, yeah, but what if this goes wrong? So having everyone understand every part and how this can play into being a great planning tool. Well, it can be a great planning tool for someone who needs guaranteed income, as long as you annuitize the product. And we talked about annuitization. This could be for someone that might be retiring early and they cannot experience and go through a market downturn. Guaranteed income is huge and it can be a great financial planning tool for someone. It's also meant for clients that are risk averse. So you can't take on investment in the market. You're scared of market volatility. You need an insurance aspect, being the annuities. So this can be a great portion to your portfolio that can guarantee that side, that can help you sleep at night and basically have your investments in that side. Leaving a legacy. So I kind of talked about the death benefit option. There are income tax rates you got to keep aware of, but this is a great planning tool if you cannot be insured from life insurance. I've had multiple people do that, just uninsurable, and they've had to go into something like this to be able to leave that benefit for their family. And then the last part is diversification to a portfolio. So it can be great inside of diversifying. So you pull risk off of the table, you put it into an annuity, and you have that difference in performance. So if the market's down and you have it in an annuity, well, you could say, well, 30% of my portfolio is in an annuity. So you take some risk off the table. Now, you don't want necessarily your entire portfolio being in an annuity because that's a pretty big risk. You want to have some substantial amount of difference and equal, weighting, I guess you could say, to just have that good diversification inside the portfolio. Okay, Marcia. All right, so we're done. So that was pretty quick. Now, let's answer some questions.
Chris, you're going to have to come off of mute.
There you go. So we have a few questions here. Do all annuities involve an insurance product?
Yes. Yes, they do. Annuities are built on the insurance model. So, if we're talking about something that might have been created a few years ago and they might be working with an investment company, they will have some sort of insurance skew inside of it. So it is going to be tied to an insurance model.
Yeah, I would add to that, just like any type of insurance, right? You're transferring risk. People buy car insurance, obviously because we have to have it, right? But aside from that, we transfer risk to a insurance company, if we got in a car accident. Life insurance, the same thing. We want to protect our income and protect our loved ones by buying life insurance. And just like JC was saying with annuities as well, it's an insurance product. And the main purpose of it, at least it should be the main purpose, is to generate some type of income for, retirement and, hopefully ensuring that as well. So it's all about transferring risk.
Yeah.
Looks another question we have here is, can you talk a little about annuities and basically how they compare with life insurance products like term and whole life insurance?
Mm-hmm. Yeah. So an annuity, you're going to have, typically when you think of a term policy, so a term policy is going to be no cash value. You can't really do anything. It is pretty much, you put your money into it and it's going to insure you for a term. So it's amount of months or years or whatever might be inside of that. So the term policy is going to be completely, you can't pull from it. You can't do anything. Some of the life insurance models, those can have cash value. But what the annuity allows you to do is if you need to pull cash from it, you can. If you want to pull all of your cash from it, you can. You can put money inside of in some sort of life insurance model, and your premiums that you paid at a certain point are just going to be inside of the insurance company. So it'll build up some cash value, and that's going to be dependent on the sub accounts the insurance company has, and then also by the performance. So you think like universal life or all of the other life insurance that's going to have an investment skew, is those are going to be dependent on those investments, but it's going to be at a certain point. Now you think of annuity compared to universal life. Well, an annuity, the whole thing is at that amount. So the annuity is going to be able to grow at the totality. The whole amount of that account is going to grow. On the universal side, they're not going to let you grow that whole account. It's going to be at a certain level. They're going to cap you off. They're going to do some different things with that.
All right. Are there alternatives to annuities that provide a reliable payout?
So the alternatives, and I always say this, and Chris, you can chime in as well. The alternatives are, well, you have to accept a little bit of risk. You think about it, it depends on what type of, income tax bracket you're in. Municipal bonds pay, they're going to pay you a structured amount of interest on that side that you're going to be able to generate some income. You've got income paying investments that are on the stock market. You've got dividend paying stocks. You've got ETFs that generate income. You've got mutual funds that generate income. So it's always going to be, you have to accept the level of risk of what you're going to be able to get yourself into. Even though there is risk in annuities, there's also risk outside of that. So it's just how much are you comfortable with taking?
Yeah, absolutely. What happens if an annuity company goes out of business?
Yeah, so that's happened. Most of the time you'll see annuity companies buy out each other, or that's kind of the really bad thing is, let's say you did invest into an annuity and it went out of business. Well, it's going to have to go through the process, and more than likely it's going to be on the state level, the state insurance board, and they're going to have to go through a process of seeing, who's everybody that lost money. Why did the annuity company lose money? What was going on? If it's a criminal investigation, then it's just going to get drawn out even longer. But then, unfortunately, you put your money into it. They told you a certain amount that was going to be guaranteed. And the bad thing is you're just going to be waiting in line, and hopefully some good news, and hopefully you get some sort of, either tax breaks of what you put into it, or maybe you get some of your money back. But the only good thing out of that is now you have a loss that you can take. And I know that's not something that we want to take. But if everything goes wrong and the state's going, well, there's nothing else we can do, you kind of lose money, but in those general terms, you get to count it as a loss. So hopefully it wasn't, if this is a real life situation, hopefully you didn't put a whole lot of money into it. But you're kind of just waiting and going through those loopholes of going through the state courts and everything else.
All right, great. What about surrender charges and surrender periods?
Mhm.
What does that really mean? That in the term.
Marche, I think if you can go back, do you still have you can go back to.
Yeah, let me go ahead and pop it up there. Do you
It
want
looks
to?
like an Excel slide. So it has the breakdown of, yeah, that one. Okay. So this one, surrender charges. So most annuities, most of them that I've looked at, they might be higher, they might be lower. Most of them are going to be at the top about 10% of a surrender fee. So their surrender fee is going to be on your account balance. So the first year that you're invested, they're going to say, well, your surrender fee for this year is 10%, but it drops down every year after that. So, it can drop down 1% per year. It can go 2, just depending on what the surrender period is. So I put this one is this client's surrender period was 10 years. So every year it was 1%, but it dropped down. So you kind of see over here where it says cash value after surrender fee. This is what the annuity company will pay you out. So you kind of see there in 2008, if this person would have surrendered the policy, that's a huge loss. $42,000 they would have received. Not only would they have been victim of market volatility, it would have been victim to a 9% surrender fee. But you just kind of see over the years, it goes down and it goes down. So, this is something that if you are locked into something, an annuity, you don't like it, you have to understand that you're going to probably pay a surrender fee if you're still within that contract period. But what you can do is just look at it and see, okay, well, is it worth paying 3% to get out of it and put it into something that might be exactly where my risk level needs to be? So I hope I answer that question. But
yeah, and I would just add to it. So basically it's a period of time, right? From, as little as I've seen as 3 years up to 10 plus years. So the purpose of it is if you cancel the contract within that period of time, you will have to pay a stated percentage, and it's in the contract itself, of the actual, cash value of the insurance policy or the annuity policy.
Mhm.
So, it's somewhere deep buried that's in there that says if you cancel it in this time frame, you have to pay X amount of percentage of the assets, basically.
And most of the times you won't even see it on your statement.
Yeah, it's not in the statement. It's usually on the somewhere in the contract when you first get the policy.
Exactly.
I mean, I know we had a question about that, and I'm glad you addressed that. But just as a lay person, I kind of think of it, if I cancel a service like a cell phone service, I'm going to have to pay a early cancellation period. So it sounds similar to that.
Yeah, it is. It is. And with how annuity companies work, they're going out and taking your premium money and whatever money you give to them, they're going out and they're going after investments. So if you remember a few years ago, 2008 happened, AIG got in trouble because they were going way too crazy on their investments. So what you want to think of it as is yeah, they are insurance products, but they're taking your money and investing it in products that can generate a good return, not only for you, but for people that have annuitized, that have the guaranteed rates. So whenever you do cancel that policy, let's say they have a certain amount of your money or whatever it is, kind of like a bank. They're taking your money and they're making money. But if they're putting your money into a 10-year bond and you cancel in 8 years of it, well, they're going to want to get some of their money back. So it's built into the insurance structure. It's built into your policy. So unfortunately, that is one thing that we have to keep in mind is you're going to pay a surrender fee.
I know, Chris, I don't know if you wanted to address this question, but on this slide, we did have a question come up about explaining a little bit about IRAs and how an IRA annuity isn't, just talk about the differences between those.
Sure. So you might be talking about, well, what's the difference between an IRA and a brokerage account, IRA brokerage account? So an IRA, you want to think of it like a vehicle. So an IRA is its own vehicle. You can take it from an IRA annuity and you can go, I'm done with this annuity. I want to go into an IRA brokerage account. Now, brokerage account is like an investment account. So you go work with an investment advisor and they put you in a fund mix or they put you in an investment mix. But there's no insurance ties to that. So a brokerage account is completely investments, and that's all they do. There's no insurance, there's no nothing, but it's still in that IRA. So with the tax code, as long as it stays in that IRA and you take it from an IRA annuity and you go into an IRA brokerage account, you're not going to be taxed, because what's going to happen at the end of the year is the annuity company is going to issue you a 1099. It'll be probably a 1099-R. Isn't that right, Chris? Like a 1099-R.
Yeah,
And there's like a tax code where it says, well, this person moved it over. They put it from an IRA annuity to an IRA brokerage account, an IRA investment account. So think of a brokerage account like TD Ameritrade, Schwab, Fidelity, Robinhood, all these other ones where you can go and invest it in the market. So that's basically what it is. So as long as you keep it in an IRA account and you just go from annuity to brokerage account, you're not going to be taxed. You'll just get the tax notice that said that, and all it is the annuity company and the brokerage company saying, yes, it stayed from IRA account to IRA account. It never left. So it stayed in that IRA vehicle. And the same thing with the IRA annuity. Let's say if you had one annuity company, you didn't like them, but you wanted to go into another annuity company, it would be what's called a 1035 exchange. So it's a tax code. So you move from one IRA annuity to another IRA annuity. So from one company to the next, and you don't get taxed on that.
Thank you very much. I think that's all the time we have for questions. If participants have some more questions, you can go ahead and type those in the chat while I do my outro, and I'll try to capture those so that we can answer any more of those by reaching out to you. Well, on behalf of Advice Chaser, I do want to say thank you to Chris and to JC, who have been our presenter moderator today. Thank you so much. We're so grateful for the organizations that have made this webinar possible. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for you and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Thanks,
All right,
everyone.
Thank you.
Bye-bye.